Good afternoon, and welcome to Rep and Warranty Insurance 2.0, tips and practices for getting the best rep and warranty insurance coverage in M&A transactions. A little housekeeping. For those of you looking for CLE credit, I'd like to direct your attention to the reminder email we circulated 2 hours before the webinar. Please fill out the form linked to that email and send it to the contact person noted. The CLE affirmation code is AG624. That's AG624. You will have to note this code on your form, and Akin Gump's CLE team will report your credit on your behalf to the state bars of California, Texas, New York, and Virginia. Now on to the discussion. My name is David Durso. I'm a corporate partner in the New York office of Akin Gump, specializing in private equity M&A. With me today, I've got a really talented group comprised of both Akin Gump attorneys and executives from Alliant Insurance Services.
Hi, everyone. My name is Larry Shapiro, and I'm with Alliant Insurance Services. I lead our representations and warranties insurance practice, and I'm happy to be speaking with everyone today.
This is Jacob Borth from Alliant, part of Alliant's mergers and acquisitions and rep and warranty team based out of Chicago, Illinois.
Good afternoon. This is Alex Perez. I'm a senior vice president in Alliant's mergers and acquisitions practice based in New York. We specialize in private equity and M&A transactions, and we look forward to speaking with you today.
Hi, everybody. This is Dave Antal. I'm from Akin Gump. I'm a partner in the corporate department out in Los Angeles, and I specialize in M&A with a focus on private equity sponsors.
Hi, everyone. My name is Kevin Tsai. I'm a counsel in the general corporate and M&A group of Akin Gump. My focus is on private M&A, both buy and sell side involving private equity and strategic. I'm also based in LA.
Great. As you can easily conclude from the bios you heard, we've got a group with a lot of M&A and insurance experience. The goal of this discussion is to share that knowledge and experience with you. Now that the use of rep and warranty insurance is the norm in doing deals, the question you should be asking is not whether to use rep and warranty insurance, but what are the steps that you should be taking to secure the best possible policies for your particular transaction? The learning objectives for this presentation over the next hour or so, we will discuss the key issues you should consider when reviewing bids from carriers, what criteria to think about when selecting an RWI carrier, the coverage options and enhancements available in the market, and how to effectively harness the market knowledge of brokers to deliver the best policies available. M&A investors who understand the RWI market are going to be in the best position to know what to ask for, how to negotiate coverage on the best, most attractive terms and pricing. Moving along to RWI Basics, looking at the list of attendees to this webinar, I could tell that you all have a lot of experience with or a general understanding of rep and warranty insurance. This presentation is not intended to be a general overview of RWI. You all know the basics of rep and warranty insurance, the benefits to buyers and sellers, as well as the general economic terms and how RWI works. So let's jump right into the specifics of getting the best RWI coverage, and we'll begin with Alliant highlighting the recent increase in using RWI.
Thanks, David. Reps and warranties insurance has been in use here in the North American market for at least the last 15 years, although it's probably received or achieved critical mass over the last 8 to 10 years. In that period of time, I think most of the metrics that we use to measure pricing and scope of coverage, it's really moved in a pretty buyer favorable direction. And in 2020, I think with the outset of the pandemic, some of that pricing direction had hardened, and a few other metrics that we use to really determine, trends for reps and warranties insurance, such as retention, that seemed to flatten out a little bit. If you fast forward through to the third quarter of 2020, we saw activity pick up pretty dramatically, and into the fourth quarter in 2020, we really saw record levels of activity. Towards the end of fourth quarter, I mean, if we look at December in 2020, that was the highest activity that we've seen historically, certainly over the 10 years or so that I've been doing this. And then if you take a look at our last 3 or 4 months, each one of those months have really fallen only behind December 2020 in terms of levels of activity. We're expecting around 2,500 to maybe 3,000 policies to be placed in this market this year. So looking on balance at historical activity, it really speaks to an absolutely heightened level of activity.
Hi, it's David Antal again. So one of the things we want to touch on before we kind of get into the details of how to implement your rep warranty is to talk a little bit about, recent developments. And Larry's already highlighted some of the trends, but also to keep in mind as a backdrop is there are a larger number of underwriters in the game now. We were seeing more like 4 or 5 back a decade ago. To by this time we're seeing upwards of 25 participants in the market, and that higher degree of participants means greater competition. It also means a wider range of perspectives on what deals are insurable or what risks are insurable. So you see a greater flexibility. And what does that mean to you when you're considering rep and warranty coverage? So that means you may, depending on how you go to market, you may be able to find some more unique, less cookie cutter answers to some of the problems. And I certainly have seen that myself in recent times. I think that this means you see better terms due to the competition, and at the same time, a greater flexibility. Once upon a time, I think you would see that the seller would need to show some true skin in the game. And now you can see structures almost commonplace where the seller could have negotiated away all exposure so that there is no portion of the retention held by the seller. We're also seeing the speed of these transactions are getting faster and faster. I think that if you are planning this, you should plan for, say, 7 or so business days, but we're seeing transactions happening much faster than that. But I think if you want to be prudent and you're going to be using rep and warranty insurance, I think you want to get that process rolling and give yourself about 7 days. If you're in a pinch, as we often all find ourselves, I think folks are doing it a lot faster than that. I mean, Larry, Alex, I don't know your views on that and what you're seeing, but I'm sure you've been compressed for time in many circumstances nowadays.
Yeah, Dave, I'd agree with that for sure. I think ideally we would take that recommended maximum period of time to underwrite, but very seldomly are we ever actually given that full, at least at the outset, very, very seldomly are we ever given that full amount of time. 3 to 6 business days tends to be the norm. And as the processes move faster, as you mentioned, we really are expected to keep pace.
Yeah. So when we're looking at this, I mean, the reason we're saying 7 business days is this is sort of best practices in the best of circumstances to have rep and warranty sort of fall into place and be an easy part of the transaction rather than a last minute headache. And so you want to give early coordination with the brokers and with the underwriters and give them the amount of time, but not to understand that if you're really short on time, that they can't motivate and move quickly as well, as we all do in the industry.
Thanks, Dave. So in terms of the next slide, it covers just from substance recognizable trends over the last 5 years. And I think what you'll all notice is that the slide is focused around claims trends. And this really dovetails with what Dave was saying just a few minutes ago. We have an increased number of underwriters in the space. And as we're getting started on the reps and warranties insurance process, a big part of the decision-making is what are you going to expect in terms of underwriting? And then really, with whom do you want to continue to develop a commercial relationship? And the decision-making that we encourage our clients to undergo oftentimes now focuses on these claims trends. and on claims history, expectations that you can have relative to an insurer's ability to work meaningfully through a process, but also work their way through a claim scenario. So, just getting a transaction underwritten is a huge part of what we do, but it really is not the entirety. And expectations on claims really tends to drive things. I think looking back, when we would first explain to clients and prospective clients what they could expect relative to reps and warranties insurance, and particularly on claims, a lot of it tended to be anecdotal. And certainly to this day, it still is. I don't think that there are, super reliable reporting on industry-wide claims experience. There certainly are claims reports out by some of the larger insurers and some brokers as well to speak to individual claims experience or experience that a particular entity might want to report. But overall, it's not as though there's, sort of objective stores of claims history as there may be with other lines of insurance. So there is, to a degree, some anecdotal background to what you can expect. But more to the point now is that I think a lot of the insurers that have been in the space for a while have a much more demonstrated claims history that we can point to now. So as we're talking to clients, it's less anecdotal and it's more sort of objective and experience driven. One other point that I think that we'd like to make relative to claims trends over the last 5 years, and even more significantly over the past 2 or 3 years, is that as the claims experience itself increases, we're seeing more seasoning. We're seeing more sophistication and experience, both for advisors as well as for insurers working through claims in the space. And we really have found that translate to a much faster and more efficient claims process.
Let's talk about organizing rep and warranty insurance coverage. And the first step is going to be working on the non-binding indication letter, also known as the NBIL. So you should always review the scope of coverage outlined in the NBIL. This is not just about cost, retention amount, and drop downs. It should also include an evaluation of the purchase agreement reps, any ancillary agreement reps that you might have to be included, other certifications, and really important, the appropriateness of any deal-specific and standard exclusions that the carriers are looking to include in the NBIL that will eventually work its way into the definitive policy. Also consider the scope of heightened risks in the core operations, areas where the carriers are looking to do additional due diligence, the scope of due diligence that's underway, and any matters that may already be noted in your own due diligence as being potentially problematic areas. Given the competitiveness of the market, a thoughtful approach to due diligence can cause some insurance carriers to reconsider some of the exclusions in order to get your business. And this is a good opportunity to approach the potential carriers with those requests. You should also consider excess coverage positions, the definition of losses, the amount of insurance recourse in the event of a material rollover or co-investment, and materiality scrapes. The NBIL is effectively the term sheet for the definitive policy. And this is the first opportunity for you to negotiate the best terms. Kevin from Aiken is going to discuss some of the specific items to consider in NBILs in detail.
Thanks, David. So as David suggested, NBILs are term sheet style letters from insurers noting the key terms of insurance coverage. And so depending on the insurer, most of the items covered on this slide are going to be covered in some way or form on the NBILs. Things vary depending on the insurer, and the description and detail also depends on the insurer, but chances are these will all be covered. Just hitting on a few of these points, the coverage options, these deal with coverage limit, retention drop downs, premiums in the event that there is a pricing, depending on whether seller is responsible for retention or if seller's not. There's also sometimes other options like tax gross ups and other things that insurers can offer depending on the deal. Two areas of focus when comparing NBILs and carriers are exclusions and areas of heightened scrutiny. So David touched on this a moment earlier. To expand on that a little bit, exclusions, there are several examples of standard exclusions that we list out later in the slides. So you can take a look at those. Some of these are under funding of pensions, forward-looking statements, and whatnot. So all these are fairly standard across policies. And then in deals, there are non-standard deal-specific exclusions that significantly undermine value of the rep or warranty insurance. And so those are things to look for as you're considering NBILs, because if there is a great pricing on a policy, but it does carve out something that's significant, that's probably not an insurer to select. So outside of the standard exclusions and the non-standard exclusions, these NBILs, they'll also flag these areas of heightened scrutiny. And so the common ones are things like employment classification, cybersecurity, environmental pollution matters. Not to say these will result in an exclusion, but depending on the industry, insurers will flag this and essentially identify these as areas where they will focus their diligence. If they can get comfortable with these areas, ultimately they will not result in an exclusion. But on the other hand, if the diligence results in any identified risks, then insurers will try to mitigate through several methods. The two common methods are either proposing an exclusion, which may not be ideal, or other options are something like requiring an additional insurance policy so that the rep and warranty insurance sits on top of that. So the other separate policy comes first in terms of recovery. Moving on to a couple of other things. So fundamental reps, some policies will actually list out all the fundamental reps. Typically this will track the purchase agreement, but ultimately, some other NBILs will just say that it's what's customary and just leave it at that. On materiality scrape, commonly this will just say that it follows the purchase agreement. And the key here is that sellers will be expected to generally prepare disclosure schedules without taking into account materiality. And that's oftentimes also noted in the NBIL. Couple last points to hit on here, loss definition. So the NBILs will usually say that there's no express exclusion of consequential diminishing value and other types of damages, as long as the purchase agreement also remains silent on this point. And so really this is an area that requires cooperation among the buyer and seller so that they can actually achieve the broader scope of coverage. If you do exclude some of these matters expressly, they will be excluded in the policy. Last point I want to hit on is on the underwriter diligence fee. So in addition to the premium, there's also a diligence fee that you have to pay up front. And this cost ranges depending on the deal. Commonly this is somewhere around $25,000 to $50,000, but this is a sunk cost for engaging in the rep and warranty diligence process, and something you should be aware of.
And this is Jacob Borth from Alliant. I think that's a good segue into selecting the insurer with who to partner through the rep and warranty insurance process. And my colleague Larry alluded to it earlier, and I think our friends from Aiken would agree. You really need to take more of a risk management approach as opposed to simply filling out an application for the insurance and selecting a carrier. And what we mean by that is it's really a marriage of selecting an insurer who is reputable and has a claims paying history, as well as has experience underwriting the actual risk itself. Not only underwriting the individual risk, but has a track record in paying claims and one who we know has staying power in the marketplace. Even from a reputational standpoint for those on the line, we're not in the business of selecting a fly-by-night insurer solely for the sake of price. So it really behooves those that are dialing in this morning to lean on the likes of transaction counsel and their insurance broker to consider industry class and associated risk, as that can vary by each individual insurance company. Certainly, the word relationship is used a lot in our industry, probably at an overused pace. But there are pragmatic advantages, and there are real dollars behind that when selecting an insurer. We want to make sure that we're partnering our clients with an insurer who has a proven solidarity proven solidarity for that particular client and that particular transaction in general. And that being said, it's worth exploring. Maybe there is an existing relationship with a particular insurer aside from rep and warranty insurance specifically. Easy examples to think about are property and casualty, as well as management liability lines of coverage. A real life example of what I'm referencing is really engaging. We recently engaged an insurer on a pre-exclusive basis for a client of ours, whereby the insurer was able to offer their pre-exclusivity fee and also dedicate themselves to the transaction timeline, which was a shorter fuse than usual, but it came in at about half the cost of their competitors, and they were able to concretely dedicate themselves and their resources to that transaction. Certainly the relationship goes a long way from this standpoint in that they have familiarity with both the client and transaction counsel, as well as the insurance broker, to assist in meeting that timeline.
Thanks, Jacob. Yeah, I mean, I think that we really can't underscore the notion of relationship underwriting significantly enough. I think it's got relevance in a variety of areas, both with respect to the underwriting process itself, and we'll oftentimes have clients that focus on particular insurers, and that insurer, over the course of a number of deals, becomes a lot more familiar with how a client engages advisors and how they address diligence. And I think that tends to give certain insurers a higher degree of confidence in, how to underwrite the risk and how to get comfortable ultimately with that risk, and that the client took appropriate steps as a reasonable buyer would be expected to do. But I think it also carries across to the claims process. As we've said before, as claims continue to either pick up pace or increase in severity, or just really, I think, become a bit more common as the insurance itself matures, we're seeing certain clients develop their own approaches to claims as well. Not that there are clients that are making, claim after claim after claim, but, the reality of it is, our more prolific clients will have a lot more deals, and, there will be a few more claims experiences that there were in the past. And so if we've been focusing on particular insurers that have gotten to know clients and gotten to know how they approach diligence, they'll also start to understand conduct in the context of claims. And we're also relaying to our clients what our experience has been with insurers overall. And certainly claims have been up. They've been up, as I mentioned, in terms of severity. They've been up in terms of frequency. And I think a lot of this is to be expected as the insurance becomes more of a mainstay. We've got, if you were to call out two of the larger and most active insurers in the space, each has reported in the aggregate on what their claims experience has been over the last number of years. I know the slide speaks to claims as of a certain point in time, and I would just say that data may be evolving. We would probably even suggest an uptick if we were to roll forward the second bullet on this slide and talk about, as of Q2 2021, the number that we quoted there for the first insurer is probably closer to 250 than it is to 200 million in a 3-year period. And, the other insurers as well, I think they're really following suit. So one of the common themes that I think everybody listening today will find is that parties are buying a 6-year promise, sometimes even longer. And the promise there is that the insurer will not only be there, but will be able to respond responsibly. And we have certainly seen that play out. And again, to reiterate a message that we made earlier, or that we offered earlier, is that as we're all sort of increasing our experience in the claims scenario, and figuring out our rhythm, whether it's advisors or whether it's insurers, but it's really, I think, important, from the perspective of setting expectations, from the perspective of moving through a claims process efficiently and really quickly, because that does tend to really steer, positive outcomes. the more experience that your advisors have in navigating the claims process, I think the higher likelihood there is for a better outcome.
Thanks, Larry. It's Dave Antal here again. So you've solicited terms, you've picked a term sheet, you've picked a carrier. So what do we need to think about when building the policy, building the treatment coverage into your transaction? What are the purchase agreement considerations to adapt from your traditional indemnity transaction that is what you're used to in life? Well, I don't think that the adjustments are really that heavy a lift overall. In fact, ultimately, using the rep and warranty policy, if you've already had experience with it, you'll know, actually removes a number of debate points, pressure points between the buyer and the seller. So what are the items that we think we need to keep an eye on in the purchase agreement? What are the pressure points? Well, first, you've got some commercial decisions to make. You've got to decide which party is going to pick up the cost of the premiums. That's easily just a money issue. You can have lots of debates about whether it really should be morally the seller picking it up or the buyer picking it up, and everyone can make nice arguments there. But ultimately, it's a money item which reduces the total amount of money that's available to either be spent on the company that's being bought or for net proceeds from the purchase price. Second is allocating the retention exposure. The retention is the portion of the policy that is borne by the parties to the transaction rather than the carrier. So before the carrier starts to kick in and pick up, there's always a retention, a certain amount at the bottom. And historically, you would see that the seller would have to pick up some portion of the retention. That would be required by the coverage. But as we mentioned earlier in this discussion, things have changed, and now you're seeing a lot more situations where the seller is able to negotiate a zero retention deal. And that has a lot to do with both the willingness of the carriers to move away from wanting to see the, quote, skin in the game, and also in the leverage situation, if you're in an auction, et cetera, where the seller has greater leverage and can look to folks and say, look, I want to be done with this once I'm sold out of this company. So we're seeing that pretty regularly. But after you get past those commercial decisions, then you've got to address what are the matters that have been carved out of the policy. Those can be taxes, they can be environmental. It depends on the industry, cybersecurity. These are matters that you're going to have to address if they're not covered in the policy. The seller is obviously going to want to say, I don't want to give any color. You need to look to the policy, and these other matters are not, something I'm willing to cover, but that's going to be something you're going to need to make sure is addressed in your purchase agreement to the extent there's gaps in coverage. Further, policies, as you probably all are familiar, do not cover known issues. So your purchase agreement's also going to need to address those known issues that the buyer is going to expect to see some indemnification. A classic case would be if there's a large litigation claim that's outstanding that people are uncertain as to how it will come out. They may, the buyer may want to have some protection on that, and that's not necessarily going to be something that's going to be coverable by insurance. Another item that is going to need to be dealt with very carefully from the seller's perspective is fraud. Now, while the buyer will get protection under a policy for fraud claims, in most cases, the seller will not be protected against its own fraud. So that may be, a place where the seller can be accused of fraud and have a claim against them from the other parties to the transaction. And so you're going to want to be sensitive when you're looking at your purchase agreement is to exactly how fraud is defined. And I say that because even though we all have a concept of what fraud is in our heads immediately, us lawyers find ways to make it more narrow or more broad than it really should be when we're all talking about what we think of when we think of fraud. Further, another technical point that you're going to want to keep an eye on, pressure point in the purchase agreement, is definition of losses or damages. Sometimes it's defined as damages. And as a more technical point, you have to make sure that that is tied together with how your policy treats it. I will tell you that the bias is that the carriers will allow you to be relatively silent as to what things are in and out of losses, sort of allowing the courts to sort of decide whether things such as lost profits or multiples or earnings can be picked up. But if you expressly include or exclude, then that's going to cause a reaction from the carrier to actually adjust the policy coverage So you may back into a more narrow policy coverage, which is bad for both seller and buyer, by being too specific in your definition of losses. So you're going to want to pay attention to that. Another area to pay attention to is the double materiality scrape. When we talk about double materiality scrapes, we're talking about, it's a term of art where we're talking about situations where the document will allow folks to make a rep with the traditional materiality carve-outs, such as, we have no material litigation, and allow recovery with reading out materiality. In other words, reading the same rep, but determining breach and damages as if materiality was not qualifying the rep. So that gives the benefit to the seller of being able to make a more clean rep that they're more comfortable with, and also less disclosure schedule burden, although there's situations where the insurance carrier is going to look for a greater disclosure. And separately, they are, in that case, also going to be picking up from $1, which is obviously beneficial to both parties, that the insurance is bearing that burden and not the seller. So that is, the big items to think about when you're talking about your policy being put into your purchase agreement. But that's just the purchase agreement. For your transaction, you're also going to need to address the rep and warranty binder and the policy. So Kevin, perhaps you can jump in and tell us some considerations for the binder and the policy. Kevin?
Thanks, Dave. And that's a great segue into the negotiation of the rep and warranty binder policy. So the first thing to understand is that the negotiation happens on multiple levels, right? The first time you see the terms, it happens in the NBIL. Then you deal with this, as Dave suggested, in the purchase agreement, negotiating definition of losses, materiality scrape, knowledge definition, all these other things in the purchase agreement as between the buyer and seller. Once you get past that stage, you have to also deal with the same type of negotiation with the rep and warranty insurer, although this is more streamlined than the negotiation between the buyer and seller. So getting into the different things you could address in the binder and policy, as Dave suggested, damage and losses, this is really important in the policy as well as in the purchase agreement. It's important to make sure that the definition is in sync with the purchase agreement, so that, this means, as Dave said, on the buy side, you should avoid expressly including things like consequential and other special types of damages. And on the sell side, not, excluding all punitive damages, because that's going to result in a broad exclusion and a very limited definition of damages. Buyers and sellers are usually aligned in trying to obtain the broadest coverage for the buyer and accordingly the broadest definition of losses. But with that said, the greater the post-closing exposure sellers have in purchase agreements, the more difficult it would be for them to agree to broad scope of losses. And so there is a balancing act there. Moving on to the breach definition, in the NBILs, there will be, in some instances, identified, I'll call it deemed modifications to the purchase agreement reps. And so, there are standard matters they address, such as, inserting knowledge qualifiers where they should go, eliminating forward-looking reps, eliminating accounts receivable collectability reps. So these things, other than the standard ones, can be negotiated with the insurers. And over the course of diligence, insurers could identify additional ones that they want to, for purposes of the policy and the binder, say that the reps are different from the purchase agreement. And so this is what the insurers do to get comfortable with providing their insurance coverage. And so those are things to look for because they could change over the course of diligence, and they are negotiable. On the definition and scope of knowledge, insurers are usually willing to agree to a higher standard of knowledge than you normally see in contracts. So knowledge is used throughout the policy, and one of the most important areas is whether the knowledge group had knowledge of a breach. Because as Dave suggested earlier, if there is knowledge of a breach, that does not mean that there will be coverage, right? That's an excluded area from coverage. So the best practice is to limit the knowledge group to the actual insurer's deal team. Usually there's 2 to 4 members. And so having a more limited group naturally means that there will be a more limited knowledge definition. As far as the knowledge standard goes, the insurers oftentimes agree to limit knowledge to actual knowledge to be proven by the insurer. So in other words, constructive knowledge is not adequate to establish knowledge. And insurers have burden of proof that knowledge group in fact had that knowledge. Segueing into the burden of proof, other than knowledge, insurers are oftentimes willing to expressly agree that they have burden to prove things like actual prejudice, intent, and other matters that, if proven, would actually limit or exclude insurance coverage. And so it's important to get these low-hanging fruits, because otherwise you could find yourself in a situation where you're fighting with the insurer about who had to prove what. Last point on this slide on the named insured. In a nutshell, surplus line taxes are taxes that are specific to insurance companies that insurance companies pass on to the insureds. So, generally speaking, there's not really a reason why you would pick one insured entity over another. But when you do select a named insured and you have entities in multiple jurisdictions, you could save a few percentage points in surplus line taxes by choosing an entity in one particular jurisdiction that has lower tax rates than another. So that's something to be mindful of. On the scope of insured, it's just important to make sure that you have a broad enough definition. And this is usually tied to the purchaser indemnified parties in the purchase agreement. So depending on how you define that, you may or may not need to tweak the definition in the binder and policy. So it's important to consider which entities or which parties are likely to suffer harm when you deal with the scope of insured. And so, for instance, if the target company is likely to be the one that will suffer a damage or a loss, then you want to make sure that that target company or the target company group are all covered as part of the scope of insurance. In a rollover transaction, it's also important to think about how the proceeds flow up to the ownership chain, because if it's paid to the joint venture entity that's partially owned by the rollover shareholders, then there is a circumstance where the rollover shareholders could somehow participate in the insurance recovery. And so you want to make sure that your documents or your joint venture agreement properly reflects the business deal in that circumstance. On the tailored exclusions, so mentioned earlier that the NBILs will usually at a high level note what types of exclusions, standard and non-standard, that they want to insert into the binder and policy. So in the actual binder and policy, you'll see the full descriptions of these exclusions. And this is an area where you can rely on your counsel and your insurance broker who have been exposed on the latest trends, because these exclusions, when they're drafted, can be more narrow. So just because you have a exclusion doesn't mean you can't have the most narrow version of that exclusion. A prime example is the COVID exception or the COVID exclusion, because at the outset, insurers really didn't know how to handle the COVID exclusion. So policy started with a very broad encompassing exclusion of COVID generally. But over time, I think insurers were able to get more comfortable and narrow the COVID exclusion to things that they actually care about, such as bodily harm, customer supplier impact. So those things are possible, and it's important to make sure that you get the benefit of the most narrow exclusion. On dispute resolution, I just want to point out that it's important to sync the purchase agreement and the policy. And if possible, this allows you to avoid litigating twice in case there are two different venues or two different governing laws. So this is helpful to, again, track the purchase agreement. On subrogation, subrogation is a hot topic as between seller and rep and warranty insurer. But as it relates to the subrogation rights of the rep and warranty insurer against the various customers and suppliers and business contacts, the policy usually contemplates a threshold. So if the dollar threshold of the dispute falls below a particular threshold, then the insured has consent rights over the insurer's exercise of subrogation rights. The corollary is if the dollar value exceeds the threshold, then it's a significant dispute with respect to which insurers can seek subrogation without asking insured for consent. So, the takeaway here is just to set a high threshold so that you expand your consent right so that you can prevent an insurer from unnecessarily seeking recourse against your business partners.
Thanks for that, Kevin. I think that's probably a pretty good segue into some standard policy exclusions and what one can reasonably expect going into the rep and warranty process. Somewhat dissimilar from the policy itself and the maturation of the policy itself. The policy exclusions have not really undergone a major seismic shift in what insurers are seeking from the outset, with, of course, the exception to COVID-related exclusions. For those that are familiar with the process and those that are familiar with the policies themselves, I don't think that some of the items here that are listed will generally come as a surprise. And that being said, many of these exclusions that we have listed here, one could make the argument they fall under forward-looking or known exposures, which, as my colleagues touched on earlier, are of course standard exclusions under these policies. One thing that I would note, and certainly it's become more than a buzzword over the last 16 months, has been the evolution of the COVID exclusion itself. And I think that Kevin did a nice job in touching on this on our last slide, certainly. Whereas insurers initially tried to take the stance, and somewhat understandably so, take the broad stance of exclusions relating to or having any sort of impact of COVID. We have seen that evolve over the last 12, certainly 14 months, where you're able to limit that exclusion if possible, and really limit that exclusion to the transmission of COVID or failure to protect employees, or maybe something relating to compliance with local laws as well. In addition to that, carriers are also taking a look, of course, at PPP loan matters and CARES Act compliance. At this juncture, it's not unreasonable to expect an exclusion relating to those items to the extent that they apply to the transaction. And more specific to PPP loans, one would reasonably expect an exclusion only to the extent that that has not been repaid as of the time of closing of the transaction. It's also worth noting that some insurers will consider a removal of a COVID exclusion if a business largely has worked remotely over the past year, COVID diligence has been done, or an impact on the underlying business has been done, and everyone collectively can reasonably state that there has not been a large impact of COVID on operations. Again, that being said, it's entirely prudent to expect some form of COVID exclusion, at this point in time in the marketplace. One other area that we would highlight as a standard policy exclusion, of course, subject to industry class and applicability to a particular transaction, would also be recognized environmental conditions, of course, again, where applicable. So again, I think this ties back to a number of things that we have touched upon in slides prior. But having the wherewithal and having the heads up going into the process and going into the policy as to what one can reasonably expect as a standard policy exclusion certainly eases the process and eases both the buyer and seller as to what to expect.
Yeah, Jacob, I think as you were saying, we've seen the policy evolve and be responsive to the global environment and to evolutions in the market. Examples of that, I think, from what you were just saying is, if you take a look at the insurance market's approach to picking up risks related to COVID and risks related to the PPP loans, we've also seen the insurance be responsive to evolutions in the agreements. And the slide here outlines an array of enhancements that, many are listed here, and there are clearly a number of additional enhancements that we've really seen take shape as approaches to deals have evolved and as the agreements that define the terms have evolved as well. I think the key here is that the insurance here is intended to be adaptive. It was intended as a deal facilitation tool at the outset and has continued to be that type of tool. We've seen reps and warranties insurance and transactional insurance, more broadly speaking, have a very positive effect in terms of competitive transactions, but we really still do see it being a deal facilitation tool at its core. So as parties have adapted in their approaches to the global deal environment and maybe revisited different structures in investment, whether it was focusing on minority investments, going into a transaction on a joint venture basis, having equity interests that are evolving over time, investing into secondary transactions. To take that approach with reps and warranties insurance years back would have been trickier than I think it is today, because we've seen insurers be a lot more thoughtful, or just to continue to evolve as the rest of us have in our approaches to deals.
So we want to talk about the best practices for approaching the underwriter's due diligence process and making sure that the underwriters are satisfied with the diligence that the insured has undertaken in the process. Since rep and warranty insurance is providing a remedy for buyers in the event of a seller breach, diligence is essential for securing the best coverage. Financial statement due diligence at the QOV level is a must, as is tax diligence, both at the jurisdictional and operational footprint level of the target. Insurers also want to see legal due diligence addressing the full scope of corporate, operational, and regulatory exposures, as well as insurance diligence that addresses how various exposures are mitigated by using other commercial insurance products. You will get better terms from the insurers if you show that you check the box on your due diligence as thoroughly as if you did not have rep and warranty insurance and were taking those risks yourselves. Don't just do your due diligence well. Make sure that you're thinking about how to evidence to the insurers the depth of your due diligence. Additionally, you should understand that the insurers see their role as supporting the transaction parties to get a deal done. They appreciate a collaborative process and want to engage in dialogue when making their inquiries rather than having adversarial encounters. Timing is also very important. Check in with your insurance brokers up front so that the broker and the underwriters know where you are in the deal process and have enough time to work through any high-risk areas that emerge as part of the due diligence process. Other considerations as it relates to due diligence are prior to making any disclosures on sensitive matters, we recommend checking the applicable jurisdictions, attorney-client privilege rules, and other privileges or protections to make sure that you are not losing the benefit of those protections by disclosing certain facts to the insured.
Yeah, David, it's interesting. We actually just had a pretty significant discussion with an underwriter relative to privilege on a recent deal. So, I don't think any of these considerations really can be taken for granted because on any given negotiation, I think almost everything feels like it's fair game. But what I would say and like to speak to on this slide is just overall with respect to underwriter expectations. There is an overriding expectation that, notwithstanding the fact that a buyer is using insurance as either supplemental or the sole source of recourse for breaches of reps and warranties on a transaction, I think insurers are expecting buyers to conduct themselves as they would whether there was or was not insurance placed on the transaction. So they are expecting a typical process, and they would expect a full scope of diligence to be conducted across the variety of exposures that may be presented at any given target. It will include, as you'll see on the slide here, financial statement diligence, legal diligence, tax diligence, state and federal. But overall, I think a conceptual understanding of what insurers are looking for might be helpful in steering our clients to figure out, what insurers' expectations really are. When you take a look at a transaction from a traditional indemnity perspective, you've got a seller that is knowledgeably giving reps, and then the seller is going to be standing behind that by way of an indemnity and perhaps an escrow. Here, when you're using transactional insurance, you're either supplementing or replacing that seller indemnity with insurance. So you're still starting with the same seller party that has been, owning and operating, presumably, the target being acquired. But they're no longer standing behind the representations that they're making to a buyer and that the buyer's relying on. We're using an insurance company that knew nothing about that target prior to the time that we presented them with the risk. So an insurer's expectations with respect to diligence, I think it really is, they're expecting the buyer's diligence to be sufficient to bridge that knowledge gap between the knowledgeable seller that gave the reps and the insurer that knew nothing about the target until we brought the transaction to market. So they're really relying on buyer diligence to help them understand whether or not the seller's representations are accurate, and if the insurer can get comfortable with respect to each of those exposures, then we would expect them to take a coverage position behind those reps.
So thanks for that, Larry, and touching on the diligence process as well. And certainly that ties back to there's specific diligence that'll be done, of course, on an industry by industry basis. And that being said, the insurance carriers also take a look at transactions on an industry by industry basis as well, which, again, as we've discussed throughout the course of our presentation, it very much behooves our listeners to rely on your transaction counsel and your insurance broker when considering an insurer to partner with here. Some examples of preferential industry classes in the rep and warranty marketplace, first and foremost on my list at least, but would welcome others' thoughts here, would be tech and software. Tech and software, we've obviously seen a boom in the number, in both the volume and transaction size over the last 18 or 24 months. But beyond that, tech and software for the most part is deemed lower risk, of course, assuming the standard diligence that my colleague Larry just touched on in the broader marketplace. Another area, and really it again is on a case-by-case basis, but professional services, bar financial or maybe legal services, professional services tend to be viewed upon as favorable industries for the rep and warranty marketplace as well. And we have it as a bullet point here, single jurisdiction businesses. That does go away, but not to put a negative spin on this or maybe back my way into my next point, but international operations can bring heightened underwriting scrutiny. So single jurisdiction businesses, if nothing else, can be easier on the process. Beyond what we have here, tougher industry classes include healthcare transactions and health providers, as well as those manufacturers and those with potential heavy environmental exposures as well. Typically, what we see in those transactions are heightened scrutiny, certainly around professional services and environmental exposures, bodily injury, as well as property damage, maybe product liability or product recall as well, all need to be diligenced as well as underwritten too. And as a function of that, the insurance carrier will certainly have all those items under a microscope. The other one that I wanted to mention is financial services or financial institution transactions. While certainly the rep and warranty marketplace has found a home for those transactions, they tend to take a higher level of underwriting on those transactions as well. Whether it's broker dealer involvement or whether it's a straightforward registered investment advisor, the marketplace has certainly warmed up to and will write those transactions. But I think that gives probably a good flavor to our audience here as to what the marketplace is preferential to.
So with respect to the role of the insurance broker in the process, we represent the insured party. If it's a buy side policy, then we're representing the buyer in the market. And of course, if it's a sell side policy, which is increasingly rare these days, but we would represent the seller in the market. So by and large, we'll act on behalf of the insured party, and we'll leverage our relationships and capability in the market on behalf of the insured party.
Yeah, and that's right. And I think we've drilled down on that, and there are certainly advantages to doing so. And as we discussed earlier, there are real dollars behind this, and it certainly goes to the process as well as the purpose of the policy itself. And I think that goes a long way for not only our individual client, but truly for the transaction as a whole. And as I touched upon earlier, and again, I welcome the group's commentary on this as well, but recognizing where there are broader commercial insurance relationships can also go a long way on the rep and warranty front as well. And not only existing relationships, but maybe former relationships. Again, it behooves all of us on the phone and all of our listeners to stop and ask the question: who are some of the insurance policies currently with for the broader client?
Thank you, Jacob and Larry. This is Alex Perez from Alliance M&A Practice. The broker certainly does take on a comprehensive role throughout the deal process. In addition to actually negotiating and placing the rep and warranty policy, the broker performs pre-transaction insurance and employee benefits diligence reviews on behalf of the sponsor. We review financials, current insurance policies, claims, vendor contracts, and loss history, to name a few items. The broker then maps out the current insurance costs and projects post-transaction costs and program structures. What we're really looking to do is identify coverage gaps, unfunded liabilities, or uninsured components of the business that could materially impact the purchase price. And we're certainly always looking for any opportunities or synergies to reduce the insurance expense and exposure post-transaction. Coverage considerations within the insurance reviews include directors and officers liability coverage. Certainly, we always are looking to place a 6-year D&O runoff policy to bifurcate the exposure between the exiting board and the go-forward entity. We also place a go-forward D&O policy so that fresh limits are provided post-close that cannot be diluted by a claim alleging a pre-transaction wrongful act. Other coverage considerations are employment practices liability, fiduciary, crime, cyber, environmental, E&O, and property and casualty insurance lines. The nature of the transaction, whether we're talking about a platform investment versus an add-on investment, will also impact the post-close insurance recommendations. In a scenario where a platform investment is made with the expectation of significant add-on transactions to be bolted on, the broker ideally wants to accept a master D&O, cyber, and property and casualty programs that allow for ease of scalability to incorporate this future add-on activity. We also want to choose carriers that can help support the growth and financial considerations of the target or of the investment going forward. It's also very important for us to understand the risk tolerance and investment horizon of the sponsor, as that can affect whether fully guaranteed insurance programs may be incepted versus self-insured programs, which have more variability based on claims performance. Lastly, a broker's role is also to help best position the PE sponsors for the greatest chance of winning the deal. In this competitive deal environment, we are seeing more deals where exclusivity is not granted by the seller and where multiple bidders are vying for the deal up until the actual signing. We find that the role of the broker and third-party providers can take on even more significance in this scenario, as the sponsor who completes their diligence, third-party work, and rep and warranty negotiation first can help win the deal where many other factors, such as purchase price, are even.
Thanks, Alex. I think that's perfect. So that concludes our program for the day. I wanted to thank everybody for joining us. And as a reminder, today's CLE code is AG624. I'll repeat that, AG624. So please fill out the CLE affirmation form, linked in the reminder email that you received earlier today, and send your form to the contact noted. Thanks again for joining us.